the market can only focus on one or two things at once, not much more than that. And the recession was pretty much at the top of the list of investors' concerns throughout last year and the beginning of this year. But now it's been superseded by other factors, such as the debt ceiling. But the reality is that the recession risk is still pretty much there. Now, the good news is that, of course, the Fed has clearly signaled their intention to pause. So unless the data shows them to do otherwise, they will not hike anymore. And that's definitely a positive, because if you think about what the driver was for the market in 2022, well, it was policy rates going higher. So the fact that that headwind has been removed from the equation is really good. But the recession risk is still pretty much there.
Before we get to recession risk, are you sure about the rates having paused now and maybe stopped now and we're going into reverse at some stage? Because what I'm hearing from Kashkari doesn't say that. What I'm hearing from Bullard certainly doesn't say that. What I'm hearing from Jamie Dimon, who's not on the voting board, but you know what I mean, is be prepared for higher rates for longer. Are we getting a little bit complacent about number one before we start worrying about number two and three?
I think the market is a bit too complacent. If you look at what consensus is thinking and what the market is pricing in terms of policy rates between now and the end of the year, there are some cuts priced in. But I think they're priced in for the wrong reason. The market believes, and consensus believes as well, that the Fed is going to track inflation down. So they expect inflation to continue falling and the Fed to track that fall in inflation to make sure that by doing nothing, monetary policy doesn't get tighter, sort of passive tightening if you want. So they expect the Fed to track inflation down and therefore ease policy. Now, our view is a bit different. We think that the economy is going to slow down to a significant degree, that the Fed will cut rates, but not because inflation is falling, but simply because the economy warrants it. So it's a different kind of reason, if you want. But in a way, the market might get it sort of right. But in our view, either rates are going to fall more than the market expects, or, as you say, there is no recession, inflation fails to come down in any meaningful way, and maybe the Fed resumes tightening. So either way, it's a sort of bifurcated outcome that the market is not fully capturing at the moment.
Right, got it.
Andrea, we do have a pulse check coming later on in the form of PMIs, the survey data of manufacturing and the services sector. And in here in Europe, we're waiting on some data as well with these PMIs. What we've seen in recent months is that manufacturing has been underwhelming, and that's reflected too in the Chinese numbers we're getting. What happens as a turning point for manufacturing from here? Because if we're looking at more rate hikes, doesn't it just undermine already weak activity in the manufacturing sector?
I've got to say that surveys in general, PMIs, ISM, and a bunch of other surveys have been a little bit all over the place over the past year or so. And that comes from...
Just take us back to COVID times, right?
Exactly. So the COVID distortions are still pretty much playing a role. And surveys are failing to capture the extent of either the weakness or the strength in the economy. And in the case of manufacturing, probably they're overstating the weakness in the economy. But that's simply because we were coming from a boom in manufacturing during the COVID period, when there was a surge in demand for goods during the lockdown phase. That now is being undone, but it doesn't mean that manufacturing is in the deep recession that the numbers would suggest. Now, if there were a turnaround in manufacturing, then of course that would be a very positive development. And we're monitoring that very, very carefully, because of course it would jeopardize our call for a recession happening earlier than the market anticipates. So we monitor particularly, as everybody does, new orders, and especially Chinese new orders, manufacturing new orders, but also global PMI new orders had showed signs of sort of rebounding from the lows. Sadly, over the past month or two, that sort of recovery has failed to materialize. So the numbers are still pretty much weak at this stage.